This is the last unit for Chapter 2 on finance. So far, you've been making money, investing money, budgeting, taking out loans, and now we're going to talk about income taxes. So, income tax is a tax that's levied on earned income or profit. Income tax is collected by a variety of institutions, mostly the federal government, states, and some cities. The federal income tax is what we will be focusing on in our class. And the federal income tax is applied to anyone who earns over $10,000 for an individual. Those people must file a federal tax return and have taxes collected on their behalf. The amount of federal tax owed is determined by your filing status and your income. Not all income will be taxed, and not all income that gets taxed is taxed at the same rate. The general process of calculating the amount of federal income tax you owe is outlined in this chart that I'm going to talk through here. The first step will be calculating the gross income. That's the sum of all earnings. Sum means the addition, so just add up all money that came in. From that, we will figure the adjusted gross income, which is the gross income minus adjustments. That number is often the number that is used to determine whether or not someone would qualify for things like the Affordable Health Care Plan or federal student loans, and other things like that. From the adjusted gross income, you can take deductions from that amount. That could be a standard deduction or an itemized deduction, depending on which one's better for the taxpayer. That leaves you with your taxable income. That income then gets put through a tax table and broken into margins so that you can determine how much tax you should be paying on that income. From that number, you then subtract credits and withholdings to determine if you get a refund or owe more money. So I mentioned gross income, and just going to review that definition one more time. The gross income is all wages, tips, earned interest, dividends, rents, royalties, alimony, property gains, income tax, any money that you earned in that year. So from that, you can figure the adjusted gross income. The adjusted gross income is determined by allowing the adjustments to reduce the income. So adjustments are eligible expenses that are used to reduce the gross income. That could be tax-deferred savings plans, a school tuition that you paid, student loans, moving expenses, business expenses, flexible spending accounts, and health saving account contributions. The taxable income is determined by subtracting your deductions from your adjusted gross income. You may choose to take either a standard deduction which is determined by your filing status, or you may choose to itemize your deductions. Itemizing deductions may include things like state and local income taxes, property taxes, medical expenses, mortgage interest, and charitable donations. Prior to 2018, you could also claim exemptions of $4,050 for every member of your household, and that was subtracted from the adjusted gross income along with either the standard or itemized deductions. But starting in 2018, the standard deduction was doubled and the personal exemptions were eliminated. So for me, because I have a small family, that was a benefit. But for families that were larger, the exemptions were more beneficial. So the change in tax law affected different families differently. So let's review that vocabulary real quickly with example 1. Sasha received $45,000 in wages and earned $1,300 in interest from his savings plan. He paid $1,400 in student loan interest and put $400 in his individual retirement account called an IRA. Determine Sasha's adjusted gross income. So Sasha's gross income is all of the money that Sasha made. So it's the $45,000 plus the $1,300. Right. So Sasha's gross income is $46,300. Now we can take adjustments from that. Sasha will not have to pay taxes on the money that he put into the IRA or that he paid for his student loans. So he is going to take that away, and he will take that away. So we're going to subtract So we've just determined that Sasha's AGI, or adjusted gross income, is $40,900. Your filing status is determined by your family situation and determines your standard deduction and your tax liability. In this situation, you choose whichever one works best for you. If you are single, meaning that you're not married, you can take $12,000 as your standard deduction. If you're married, you can choose either to file jointly or separately. You'll see that marrying filing separately is the same deduction as the single. You can be head of household, and that's if you're not married and you're caring for a dependent. Or you can be a qualifying widower. Let's work with filing status and see how this might affect Maria. Maria earned wages of $32,400 from her job as a server. She also earned $8,300 in tips and received $95 in interest from a savings account. Let's stop there and determine her gross income, because that is all the money that Maria was making. Okay, so Maria was making $40,795. Now, Maria's adjusted gross income is the gross income minus any adjustments. The adjustments that were outlined were her retirement contributions, and that's all that we see. So we'll take the $40,795 and we will subtract the $3,500. Now we're going to figure out Maria's taxable income. To determine her taxable income, we'll take the adjusted gross income and take the standard deduction, which is what she's decided to do. So we'll take the $37,295, and because Maria is unmarried and has a dependent, her 6-year-old daughter, she qualifies as the head of household. So Maria's taxable income is $19,295. Once you figure out someone's taxable income, you can take that to a tax table. The United States has a progressive federal income tax system, which means that the more income you have, the more you pay in taxes. There are marginal tax rates that go up according to your income. But we do not pay the same amount on all of our income. The ranges of income are called brackets or margins. And this is the math that I really want us to focus on. And this is the largest misunderstanding or misconception that folks have about how you are taxed. Even though someone might fall into the, let's say, the 22% tax bracket, not all of their income will be taxed at 22%. The income that falls into the lower tax brackets will be taxed at that lower amount first. So let's take Avery as an example. Avery is filing as a single person and has made $55,100 in taxable income. Calculate their tax. What I would do is I would find where $55,100 lands, which is right there. Ignore the $82,500 because Avery did not make that much. I would replace that with $55,100. Avery is going to have money fall into 3 tax brackets. The 10% tax bracket, the 12%, and the 22%. What you need to figure out is how much money is in each of those tax brackets. The first one's relatively easy. From 0 to 9,525. That is 9,525. All you need to do is really just subtract these two numbers. How much money is in the 12% tax bracket? That is how much money is between $38,700 and $9,525. You can subtract these numbers from each other in order to determine how much money is in between those two numbers. We found that $29,175 is in the 12% tax bracket. Now, Avery needs to figure out how much money is in that 22% tax bracket. So instead of doing the 82, what we're going to do is the income that Avery had made. And then subtract that from the bottom of the bracket. So only $16,400 has fallen into that last tax bracket. 10% of the 9,525 of, again, multiply, and 10% as a decimal. Then we'll do 12% of the 29,175. That's 3,501. And then lastly, we'll figure out 22% of the $16,400. So Avery will need to pay a total of $8,061.50 in taxes on the income that they had. I want you to try this process for Adria and Phyllis and Gladys. Adria is filing head of household, so you'll be needing to use the second column to figure out her taxes, and Adria is making $86,000, so Adria is going to be falling into the 24% tax bracket. And Phyllis and Gladys are married filing jointly, and they're making $112,000. So you'll want to have theirs figured out for the up to the 22% tax bracket. Okay, now after someone has determined how much tax they owe, they also get this last little bit of help with their taxes, and that is that they can reduce that bill by having credits applied and withholdings subtracted. Both credits and withholdings will reduce the amount of tax you owe by the full amount of the credit or with the withholding. After this, you are left with the amount of tax you owe or what you will be refunded. Shiro is in the 22% tax bracket and itemizes his deductions. How much will his tax bill be reduced by if he makes a $1,000 contribution to charity? And so that's a deduction. Charitable contributions are. So we need to figure that out. So we have a $1,000 deduction. And we're going to compare that to a $1,000 credit. If Shiro's in the 22% tax bracket, this $1,000 will decrease his taxable income by $1,000. So it will save him 22% of that $1,000. Because that $1,000 won't be taxed. So it will save him $220. A $1,000 credit, on the other hand, will take his current tax bill and it will subtract the full $1,000. So this will save him, this math is not difficult, it will save him $1,000. So which is more valuable? Which would you rather save, $220 or $1,000? One might argue that it's more valuable to contribute to charity. Mathematically, you would say that the credit is more valuable. Sometimes you'll be given an opportunity when you're doing your taxes to decide if you want to take something as a credit or a deduction. And generally speaking, you want to take it as a credit if what you're trying to do is pay less in taxes for that year. John's taxes are $5,300. $442.50. He can claim an American Opportunity Tax Credit of $2,300, and he's had $4,135 withheld from his paycheck. Determine if John will owe money or get a refund. John starts by owing the $5,300, and then we will subtract his credits, and we will subtract what he has already paid in taxes this year, the withholdings that he's had. You will see that you've got a negative number, and you need to interpret that. Does that negative number mean that he owes money, or does that negative number mean that he now is owed a refund? So think about it in context. He originally owed $5,000. He could take away these things to reduce his bill. And so this negative number represents a refund that he should be getting. I want you to do example 8. Work with the math that you had done from example 5 for Phyllis and Gladys, and determine if they will need a refund, if they will need to pay taxes or will be receiving a refund. And if so, by how much? That is the end of our unit on financial math. I will see you in class. Thank you. Have a good one.